what really we are about, or what really behind the market is really into. You are looking at interesting aspects like, what exactly is obtaining behind the markets. Copper prices, of course, looking at issues on the international, both and local markets, and what, of course, is really the elements of what trade is pretty much made up of, especially on the local markets. Considering interesting factors of the kwacha appreciation or depreciation. As you may know, of course, we've had a rather bad experience, of course, of continuous depreciation of our currency. Hence, that, of course, has quite a lot to do with what, of course, you're talking about when it comes to issues of the economy in this very country. But of course, Mutwale then will be joining us, so we can pretty much get on and be able to have a chat with us this morning, just to really get us through the interesting aspects that we're looking at today, this morning, on Just Behind the Markets. Of course, yesterday we had very interesting takes with regards to just what is obtaining around the issue of, ideally behind the markets right here on Money FM. So, of course, those are just, joining us. You feel free to be a part of the conversation by just, coming through our social media platforms. That will be Twitter, Facebook, as well as, Instagram. All those, three platforms, you can just join us and be part of a conversation by just logging into your social media account, and we'll be more happy actually to hear from you. Good morning to you in case you're just tuning in, and of course, just to really delve into the interesting aspects of what we have for you today with regards to just money and the economy of the country is concerned. Now, we did have a look at what the currency situation is like against the strongest most trusted currency from the world, and how basically they are doing. And as we speak this morning, we know that at least United dollar is equivalent to 20.06. That is not something encouraging. We were hoping at least, as promised, that would have a single digit inflation. But as we speak, we're looking at South African rand, of course, at 1.09 kwacha, and we see that we're looking at the Great British Pound trading at about 24.32 kwacha, and a euro at 21.32 kwacha as of today. Now, of course, rates may vary due to market conditions and whatnot, but of course, currently that is, the bracket where we have the currency kwacha, of course, trading at not doing so well, of course. But with more scenario coming through this morning, just ideal on what's happening. And if you have a look at stocks, of course, on the global or international market, of course, you see that there are interesting aspects and how just basically they are faring as of the day today. We are seeing declines from companies like Dow Jones Industries, S&P 500. You're looking at APL, Apple in short. You're looking at least negative 0.34% as of today. S&P rather 500 looking at 0.30%, and rather Jones Industrial, you're looking at also rather negative 0.071% as of the day today, just as you're starting the year, of course. And what really happens is understanding the triggers of this decline, maybe in losses and whatnot. It all comes down to how these triggers actually being handled. But just Mutwale, how are you? Welcome program.
Good morning, Vernon. Good morning, and a happy new month to you. It's always a question of whether it's a happy new month. People are always going to ask the question, is it a happy new month? I think due to the news that keeps coming out. I don't know if you can hear me.
Loud and clear.
Okay. So that being said, let's get down to business or this is business of the day. So yesterday we did continue seeing our currency markets, and we will go through what we've seen here in terms of the markets. But yesterday we did continue seeing our currency markets continue a slide, a progressive slide, which hasn't stopped since the beginning of time, effectively. We did unfortunately see that our kwacha has continued a journey down the path of unfortunately down the path all the way up to 18.09. So 19.08, and it is projected to continue its journey all the way into the 20s. So yesterday we saw it close at about 19.84. Sorry, that was the actual close yesterday. And it is projected, I think everyone is kind of trying to figure out which direction is the kwacha going to continue its movement in the negative or positively. And we're seeing obviously in the rand. So the problem right now is this kwacha is losing about 0.15% on a daily basis. Okay, so it's actually losing about 0.15% on a daily basis, and a lot of that is adding quite a bit of inflationary pressure to our mix. Now, the other problem, obviously, is that is then it's also gonna that is also gonna continue reflecting in other parts of our markets as well. Now, we also do see that in our markets we are seeing. So we also do see that in other parts of our markets we are seeing that commodity prices are also continuing to move at a negative click as well. We did see that oil is kind of moving between this 80 and 85 mark, projected to end this quarter around 86. Obviously, oil being the big news because of what happened yesterday, but we'll go through that in detail. But oil continued to move around in the market, about 83.73 closed yesterday, 2.06% upwards, mainly due to news of the Chinese recovery and the expectation of China's recovery. Now, looking at the news yesterday, and I want to just go through some of the harder global news, because I think today what I'm going to do is go outside in. Because quite a bit of the news in the market is actually inside our is in our domestic market, and we'll break into that a little bit longer. But yesterday we did see data from China showing that the manufacturing recovery from China was actually stronger than expected. So we saw the Chinese manufacturing PMI, which was projected only to be at 50.5, to actually come in at 52.6. Non-manufacturing PMI is at 56.3, above expectation, and therefore Chinese Caixin PMI coming in, or Chinese Composite PMI coming in at 56.4 when it was only about 52.9. This puts these figures at relatively high points. This is strong optimism levels in the Chinese manufacturing sector. And that strength in the Chinese manufacturing sector is what is probably driving, is what's potentially going to drive a few commodity prices to start jumping upwards. So we're talking about a 5-year high in Chinese manufacturing optimism of 52.6. Okay, that is higher than we've seen in terms of the reads in PMI. That is the highest that we've seen, and that we have to go all the way back to 2012 to see an optimistic Chinese manufacturing sector like this. That read is actually signal over 2012. So we're looking at over an 11-year high in the optimism of the manufacturing sectors in general. And then the Chinese composite PMI also being relatively strong as well. It's non-services one, but composite PMI is the highest it's been since June 2022. And that's mainly because of the service sector, which has been the strongest part of it. But right now, you do have a strong Chinese rebound. What's that doing right now, Vernon? Oil prices are now starting to rise up because of all these stronger than expected expectations. China's recovery will actually push oil prices up faster. China's recovery will also push copper prices up at the same time. So that mix of oil and copper prices going up, it's going to be a bit of what we call an inflationary growth story. So yesterday we saw oil push up a bit further into 83.95, heading towards 84, while copper is back up above 9,000 kwacha. In terms of where it's trading this morning, mainly because of a strong read in PMI data, and it's lifted all of the Asian territory. It's lifted oil, it's lifted commodities, it's lifting everything around the board. So that partially is positive news for Zambia, in that we might get a dollar flow coming in from copper, but unfortunately it's making the oil more expensive that'll come in. So it might actually stem things off. So stronger manufacturing reads from China. Now, this has to continue. It shouldn't just be a once-off. It has to be a continued story. So the recovery of China is actually one of the biggest. It's actually one of the biggest stories on the market right now. And that's what's solely driving a lot of the commodity sector. So when you look at the commodity sector yesterday, and I think how it closed out yesterday, here's the main data read that we have in terms of commodities. As I said, 83 on oil, $83 on oil, pushing the price up 2%, and then we're actually heading towards 84 in the open of this morning. It closed copper closed yesterday at 8,983. Now it's above 9,080. So we've actually seen all these commodities moving upwards again and recovering, and gold is up 1,837. When you take a look at the sector in terms of your wealth assets, you did see that your things like your crypto assets and your Ethereum assets all came down yesterday. They had a negative day in dollars. And therefore, the Kwacha value came down 0.83% in Bitcoin and 0.53% in Ethereum. So, for digital assets, digital commodities, it was a tough day. While you saw gold up 1.13%, so gold is up 10.3% year to date. Obviously, wrangling what is happening with the dollars. Sorry, it's mostly reflecting what is happening in dollars versus what should be happening in kwacha. So that unfortunately is the mix right now. The dollar. Sorry, it is actually reflecting the move of the dollar more than what's actually happening in the actual commodity itself. Because in dollars, gold is only up about 1% year to date. So if you're looking at your year to date assets still, you're seeing about a 4.96% upward movement in bonds, 1.2% downward movement in the stock market, and a 9.46, about a 9.46 movement upward in the US dollar, 10.13 movement upwards in gold, while 53% up in Bitcoin year to date and 48% upwards in Ethereum. I'm going to have to say this again and again and again and again, and I'm going to keep saying it because unfortunately some people are very happy-go-lucky and quick to the races. Cryptocurrencies and digital assets are still highly risky. Okay, you hold them as a component of your portfolio, and they keep giving you that. So the fact that we're reporting on them is so that you're given a wide range of information and as much information as you need to make the best decision you can. But you must also understand these are wildly volatile assets. Because if you look at the 1 year trajectory, yes, year to date, these things are up 53% like Bitcoin. But on a 1 year space, it's down 39.4% over the last trailing 12 months. So you can't make a snap decision too quickly. So just always bear that in mind. Always, always, always. And I'm really going to stress this. Always bear that in mind. Now, let's take a look at some of the data that's actually coming out of the markets in terms of news items before we get into the major parts. Though quickly, just to also state, our bond markets are also up 0.6% year to date, up 4.96%, while in dollars, bond yields are down 0.02% yesterday. Are down 0.02% and year-to-date down 4.26%, reflecting the poor performance of the US dollar. So if you are offshore, you are seeing, unfortunately, reflecting the poor performance of the kwacha and the strong performance of the US dollar. So unfortunately, that's playing negatively against it. So remember, if you're an offshore investor, your portfolio always, whenever you see a weak currency and you've got property projects on the line that you're working on, that's the time to complete those, because the building materials and all those costs are you've got a little bit of a discount on them, especially if you're earning external currencies. So if you're, let's say, earning dollars, pounds, euros, and you're living somewhere out there, or maybe even rands as well, this is the time to then look at your property projects and start to work on completing them. While simultaneously, if you're earning but when the currency does strengthen, and that will probably happen only when we start to see a stronger read in terms of when we start to see a stronger read in terms of or when we start to see a much more positive situation in terms of the protracted debt negotiations. That's when you'll probably see the FX rate move more to the positive side. Now, so for that, whenever you're navigating as an offshore investor or as a Zambian outside, finish your house when the currency is strong. Buy bonds when finish your house when the kwacha is weak. Buy bonds when the currency is strong. That's how you build your bond stock, your bond property portfolio. That's what you kind of return to. So you have this little bit of diversification. But when the economy is doing well, you've got a good property portfolio. But then on the other side, when the economy is doing poorly, now you've got this bond portfolio that you can also lean on and you can continuously keep reinvesting in. So that's kind of the mix of things that you want to try and utilize as a person trying to build your offshore portfolio coming back home. It's bonds and property. That's actually the way you want to try and mix it up. You want to play the stock market too, but I always urge people that the first thing you want to try and do is build up bonds and property. It's an insurance policy. And I know some people like to say, some Zambians may not want to return. Some Zambians may want to return. The question is, 95% of Zambians abroad keep their passports. you are still very likely to return as long as you're keeping your passport and you have not changed your citizenship. That's the reality. So we always have to make sure there's an insurance policy of you back home being able to return to a portfolio. Okay, something that will be able to take care of you in the event you're a high earning job, which most Zambians abroad have. They've got very high paying jobs or very high paying opportunities outside, higher than what they would have here. Okay, now I say the word majority. I know you can tell me, yes, there's Zambians out there who go and suffer, but the majority of Zambians who are living abroad are living a much higher class lifestyle, earning much higher earnings. We're talking about people who are earning $10,000 to $100,000 a year. When it comes to earnings, and therefore they're able to remit much stronger than the Zambians here. In fact, they're not even earning $10,000. They're earning a lot of them are earning about $2,000 a month, $3,000 a month upwards. Okay, already upwards, and that's a struggle for them there. So you have to understand that Zambians abroad have got a much stronger link to investing back in their country. And if we can try and give them a strategy that they can employ, therefore the offshore strategy that I always give the Zambians abroad is property bonds. That's usually the easier one. But if we had taken off real estate investment trusts in Zambia, that would probably get a lot more people a better read. Now, obviously, when it comes to property, there's always the old school view that you want to physically own it, but those are the options that people have. Now, I just want to quickly go into the rest of the international market and what we should be looking at in terms of the major stories. Now, obviously, the big story is China's manufacturing recovery and what effect that is actually playing on the rest of the market. But in terms of interest rate data, we did see credit is actually moving through South Africa. It grew by 8.4%, driven by the money supply growing by 9.4%. And this is a reversal after a 3-month consecutive slowdown in the growth rates of credit and money supply. So we're actually seeing a positive bump upwards in terms of South Africa having a bit more money. That's going to do two things. One, that's going to give South Africa a lot more money to start pushing outside of its economy. Now, remember, South Africa is one of the strongest lenders into Zambia. So if you start having South Africa having excess money, that also means that they can now push some of that excess money into countries like Zambia, filling up a lot of our credit and debt markets, and therefore putting a little bit more money into our supply as well. So if they want to diversify into any of their financial institutions, buy up some of our government bonds, those are some positives that we start to see in terms of the date, in terms of the news that came out yesterday. So seeing South African credit growth and money supply growth would actually be a positive when it comes to Zambian information. Now, other pieces of news that came out yesterday was German inflation. In terms of the inflation reads, German inflation continued to slow down, but unfortunately, Spanish inflation heats up from 5.9 to 6.1. So we are getting mixed reads out of Europe. Uganda's inflation dropped below 10% to 9.4% for the first time in 4 months, while South Africa experienced the largest trade deficit since May 2022 of $23 billion. Why is this important? A trade deficit in South Africa weakens their currency, therefore makes it cheaper for us to import things from South Africa. So a trade deficit actually signaling South African imports may actually start to get a little bit cheaper because South African currency is a little bit under pressure due to its trade imbalance. Other parts that we saw was industrial news yesterday. Japanese construction orders dropped to an 11-month low, to negative 14% growth, but Japanese housing starts grew to a 15-month high of 6.6% growth. So we're actually seeing grew at a 15-month top level of 6.6%. So the Japanese housing sector, and right now, is showing that a lot of housing construction has started, but unfortunately, orders through the construction industry is also slow. So that's going to speak slowly to our copper. In the other parts of the economy, the Swiss economy continued to grow at 0.8%, and it was below expectations in the fourth quarter. Remember that Switzerland is our biggest purchaser of our copper as well. U.S. housing prices continued to slow down to 6.6% year on year, with Italian industrial sales up 14.9%, beating expectations. U.S. wholesale orders see the first contraction that they've seen since September 2020. So what are we seeing? Weak industrial growth, except for China's massive recovery of 52.5% in terms of their PMI. That is overpowering all this negative news. This shows you how powerful China is in the mix of the equation and how strong they are in terms of determining our commodity prices. And finally, in terms of global income growth, we saw that Indian GDP slowed down from 9% to 7% in terms of preliminary data. That's one of the top growing economies. South Africa's unemployment rate declines to the lowest that it's been of 32.7% since June 2021. However, the unemployed population is up 30,000 people. Brazil's unemployment level drops to a 7-year low of 7.9% following 10 consecutive months of drops in unemployment. One of the things that took out Bolsonaro was that Bolsonaro did not deliver on drops in unemployment. His unemployment levels went from 14% to 11% and then back up to highs of 14% due to the pandemic. The Canadian economy continues to slow down in growth due to the slower oil section. So we are seeing that there's much slower global growth. Signs of unemployment, yes, with Brazil, but there's much slower global growth. Industrial data is showing some weaknesses and mixes of data, but mainly it's China that has revived it. Interest rates, we are seeing a little bit more credit moving through South Africa, meaning that they'll probably have more strength to participate in our bond market, while we're seeing that inflation data is slowing down. German slowdowns in inflation, Uganda slowdowns in inflation, South Africa probably having a weaker currency at the moment versus we'll probably have the currency is not going to be picking up in strength anytime soon. So slowdowns in inflation around the world is showing slowing inflation. Interest and credit might be starting to get a bit more available, but unfortunately the growth opportunities are getting weaker and weaker. So we still have weak growth and a monetary sector that's starting to rebound, but still underpinned by weak growth. That is what the four horsemen are telling us. Now, the two biggest stories of yesterday. One is the oil adjustment. So yesterday, the Energy Regulation Board adjusted petrol by about 4%, based on they adjusted petrol by about 4% upwards, 4.3% upwards, because by 1 kwacha 13 ngwe, because of 5% increase in the cost of importing finished good petrol, and what they said was a 2.65% increase in the value of dollars, or the cost of dollars, which then came together in a 4% increase in the pump price. Now the pump price is sitting at record levels of about 28. It's sitting at about 20. It's sitting about 28.52 starting today. And we had this conversation yesterday. We had it looking at 92 ngwe instead of 1 kwacha 30 ngwe. Now, the biggest driver for us was the loss of the currency. We didn't see the loss in crude prices, because crude prices were sitting at about, crude prices in general, because we're looking at crude, not processed oil. But crude is what we track, and we saw that move zero throughout the month. So we didn't see the price there. So if the oil sector is seeing a 5% increase in the average price of processed good, it means two problems are happening here. Procurement and production costs are actually too high for the finished goods. So either getting the finished goods into Zambia is the problem, and that would probably be the same even with crude, because you can even buy crude, but still the procurement costs are still going to be evident in there. So one of the problems we are facing as Zambia is the supply chain of getting oil into the country. Okay, this is problem number one. Evidently, whether crude or whether finished product, the supply chains that we're currently using are far too expensive. And that's actually causing quite a bit of an inflation danger to our economy. Now, yesterday we did speak about the fact that the oil sector, or the transport sector, has become more sensitive to the oil price movements. So a 4% oil price movement will reflect in a higher percentage movement in the transport cost. So transportation sector is no longer sitting as a little bit moved by the oil price. It's now drastically being moved by the oil price, and it's been that case since September. And transportation is the key driver of the cost of living right now. And they're not just talking about putting fuel in your car, the cost of it, the costs of moving everything around. Employees start to ask for more money. Costs of moving food around. The very food we're trying to keep their prices low, those costs of food start to pick up. Okay, the very costs of shipping things around, that cost starts to go up. The cost of travel, when you're trying to take a vacation, say you want to drive down to Livingston, for example, and take your vacation, the cost of that total trip starts to increase. The cost of busing starts to go up. And remember, a lot of people move things around by busing, selling something in Lusaka, trying to get it sold in the Copper Belt. It's that busing price. You have to then add in the cost of trying to move that busing around. So that adds to the price of any good. So interprovincial commerce starts to go up. Remember that we don't grow the maize in this country next to the milling plants. The maize is grown in the maize belt of Zambia, central province to eastern province, and it has to move from there into the milling plants. It doesn't get there
Yeah.
by magic, it gets there by truck. Okay? And the truck has to put oil in it. Now, the price of diesel didn't go up. That's the only good part. So I think what may slow down a little bit of
Yeah.
the knock-on inflation to other areas is that diesel, because most of the trucks that move around use diesel. The price of diesel didn't, fortunately, didn't go up. But the price of petrol is going to put a lot of pressure on those who are earners of wages, and therefore labor costs may start to experience a little bit of pressure, which may start to reflect into the cost of doing business for labor-intensive workers. Now, what we probably will see again, because it looks as though the transport sector, the public transport sector, has reached its wits end. So probably what you will see is the price of transport, public transport, be it buses, intercity buses, those ones will probably start to go up. So you have to prep yourself for that. So there is pressure. So let's say a lady who's coming in from Kafue with a sack of tomatoes and has to move it into City Market, which you see a lot of, by the way, or coming in from these upper areas, she's going to have to increase her costs because she's experiencing higher transportation costs, which is narrowing down her margins. So if you think about a lot of the market-driven food, that's what we mean when we say transportation costs. The place with which she stores her tomatoes or gets them from at the central place, and the place with which she sells them from, those are higher costs. Maybe the people who bring them in. So not all those things are brought in by diesel. There's a leg of the transaction that uses petrol. Okay, so I just wanted to put as much of that into context for as many people. So there is a little bit more inflation pressure, but it may not be as strong because diesel prices for the actual industrial transportation sector may not go up, but diesel prices for the retail transportation, I mean, petrol prices, which affect the retail transportation sector, that will probably go up. So in transportation costs, our transportation inflation may not be as pronounced as it was in the previous month because of diesel prices, but this time it'll still be significant, and therefore it'll be the main thing pushing prices upwards. Now we are still battling, by the way, with the cost of things like mini mill. Mini mill was still moving up about 7% last month, and it has to ship around. It has to move around. So remember that there's movement costs that are actually factored into all of these as well. Now, where do we foresee this going? Okay, I think everybody's question, which I keep getting asked, is Munyumba, where does this end? Because this looks like round and round she goes. Where it stops, nobody knows. Here's the struggle that we're all going to have if we're while looking at this. One, the kwacha is going to continue weakening until we resolve this debt issue. The kwacha will continue weakening. Okay, that's a conversation that we're struggling with right now. So how much will the kwacha continue weakening going forward? So I've done a few projections. This is based on the current trajectory. I'm going to say this again, Vernon, because unfortunately, this country, I have to say things like 8 times. Okay? This is based on the current trajectory. This can be changed if we fix our debt situation. Okay? This can actually change if the debt negotiations start to change. But by the current trajectory, this is what I foresee. This is what the numbers are showing me as where the kwacha is going at the current trajectory. I'm going to keep saying that multiple times so that people make sure they get it. At the current trajectory, by the end of March, we should be seeing the kwacha at 20.4049. Okay, at 20 kwacha, 20 kwacha 0.4049. That's where the exchange rate will be. At the end of April, we're looking at about 21.1817. 1817. At the end of May, we're looking at 21.9844. And by the end of June, we're looking at record territory at 22.7612. Whoever is negotiating, really, these are the things they have to keep in mind. We're back to record levels of exchange rate of 22.7612. Now, that's good for people who export, horrendous for people who are importing. The problem is the Zambian consumer is a net importer. So that's where the struggles are going to come from. So if you're looking at the projections of where the currency market will be, take into consideration that that is going to be the biggest pull. That is going to be the biggest pull factor for Zambia in terms of the projections are showing that the FX rate. Now, this FX rate is reflecting a continuous, and this is why I was not too confident when they were saying it was mainly due to the cost of oil prices. It's actually reflecting a continuous 3% rise in oil in the FX rate. Now, yesterday, let me give you an example. Then, last month we saw the sorry, this read, we saw the price of oil go up by 4%. But we also saw the FX rate on average also rise by 4%. So it is starting to look like it is purely, Vernon, the FX rate. So in next month, we're expecting the kwacha to go up by 3%, 3.8% the following month, 3.7%, then finally start to slow down by 3.5%. So we are expecting the kwacha to continue moving at a click of somewhere around 3.83. So it's anywhere between 3 to 3.8%, or on average, what we're looking at is about 3.5% on a monthly basis. The dollar is going to get stronger by 3.5% every single month continuously until this problem is resolved. So this is what those who are trying to negotiate our debt situation must keep in mind, and the inflation pressure that it's actually coming with. So bear that into consideration. I'm sure, Vernon, when you start seeing the bus price, that's when everyone will wake up to this. When you wake up and you start seeing those bus prices. Now, I've also often said that when it comes to bus prices, my concern is this. We're all hoping to say, oh, hopefully they don't raise prices. My problem with that industry is if they don't raise prices consistently, they will raise prices drastically. So what happens one day, because they've been holding back price hikes, is bang, there's a huge one that comes. And that's what you're trying to avoid, those huge shock ones, which scare everyone. You'd rather have these tiny incremental ones so that you're prepping your mind for it than to have this huge shock one. This is why I've kept on saying that in the busing industry, what we should be talking about, and I've asked this question even at the transport sector, is if you can have the people who decide this, be it RTSA, be it the Ministry of Transport, the Transporters Association, and maybe somebody, I don't know which departments, but to sit down and have a quick council who can run a publicized equation where you simply put in what is the growth in inflation. You look at inflation movements, you look at the oil prices, you look at taxes to the drivers themselves, and you formulate a cost of transportation services and maybe the FX rate because of wear and tear of buses. So if you put all these things together, you can then put a transporter's price. And if we had a publicly known equation, we could all then predict the changes that were coming. But the problem, I think, is we don't. And I think
Absolutely.
this has been, and as much as people like to say, this monthly thing, this monthly review, yeah, the problem I had with the quarterly review, Vernon, was that when a change was done, you would move from like 9 kwacha of the pump price to 13 in one movement. That's the problem I have. You'd like move
Yeah.
50% as an increase in oil prices. That's how big the shocks were coming. Or you'd move from like 9 to 11. It was always these huge 20, 30% movements whenever it would happen. There'd be no oil price movement for like 9 months, and then bang, this huge one comes, which you have to now adjust to instantly, as opposed to maybe having a 3-4% adjustment on a monthly basis, reaching up to that. And this is because this is the problem I have with quarterly review and semi-annual review, is that when an adjustment is done, it is done brutally and it is done viciously. And the second problem I have with the semi-annual and quarterly review is the shortages become more persistent. Remember that whenever these guys start to look at the global market and their acquisitions of fuel, and they look at what they're selling right now, when they start seeing that they're making a loss, they start taking stock off the market. That's what happens in the petroleum sector, is that these people start taking stock off the market, and you're going from complaining, oh, the prices are good, but there's no fuel in the stations. Okay, that's where the problems start to happen.
Yeah.
So you're trying to balance actually having fuel supply with yes, a decent price. So, what does this mean in terms of policy prescriptions that have to take place? Well, the policy prescriptions that have to take place in order for us right now is we have to change our supply chain. It is evident that the cost of bringing fuel into this country is expensive. It is evident. Okay, whether it's crude or whether it's finished products, it's evident that the transportation costs are becoming too expensive. So this means that whatever is being done with that pipe coming in from Tazama, that has to be fast. And secondly, I know we're talking about in 3 months the mixing. The problem is the fuel and ethanol mixing is a promise that has moved twice already. We cannot have that thing continuously moving. They have to set a date and stick to it. Whether it's going to be in 3 months, 6 months, whatever, they have to set a date and stick to it. Because let me tell you what's happening. A lot of the market players are becoming more and more skeptical of the things that the officials are saying. They're becoming more and more skeptical. And I'm talking about proper market players who are supposed to be objective. They're looking at a lot of things with more skepticism because every time there's something said to blow out and to whether it's to impress people, whatever. But then when the date comes, it shifts. So we have to make sure that we're delivering on the dates. Okay, this is what the officials have to now start doing. So if you're saying that you're going to start blending fuel and ethanol, you need to start sitting down with these three main companies and saying, guys, where are we on this? Where are we on the ethanol production so that we can start bringing down part of the cost? Because if you're dealing with 10 to 20% of the cost of fuel being dealt with by locally produced ethanol, you are taking FX costs out of it. You are taking production costs down. You are taking transport and logistics costs down by 20% of the production. Now that has to be done ASAP, but it still has to be stuck to. So if it's going to be started in 3 months, which the minister did say the last time, then, and that was a month ago when he made that proclamation, then it has to be followed through in the next, and we have to be able in the next 2 months, and we have to be able to see this because in the next 2 months, Vernon, we're expecting that there's going to be 6% price pressure on fuel. So expect your fuel prices to continue moving upwards by at least 3% every single month. Okay, expect this. Okay, especially with news that China has recovered. Just think very carefully. China is the number one importer of fuel. Okay, or sorry, of crude oil. As China is the number one importer of crude oil, they are going to be importing heavily because their manufacturing sector is recovering and their non-manufacturing sector is sitting at record highs as well. Those two things are going to drive up Chinese demand for oil. And stronger Chinese demand for oil in the risk that Russia is going to try and push down oil supply by 500,000 barrels a day. Those two combined forces are going to pressure the oil price up to 86, 87 in terms of the Brent price. Okay, while simultaneously you've got a kwacha that's going to be losing 3% value every single month. So if you're moving the oil price up from 83 to 86, 87, and it's moving up in that direction, while simultaneously you've got an FX rate that's moving 3%, that means every Zambian needs to put into their mind that their transportation costs, or at least the oil costs of what they're putting into their car, is going up by 3% every single month. Okay, at least 3%. Okay, so put it in your mind, 3 to 5%.
Interesting takes, right? There's been interesting sentiments coming through from economists and business analysts talking about how they perceive that you can possibly stabilize the currency, the kwacha currency, by increasing more forex and exporting more of goods in Zambia. But then if we can have crude oil being processed right here locally, that means we'll have in view of stabilizing the currency. I mean, some people believe that if we can do more forex exchange, do a lot of exports, we can possibly stabilize the currency.
So here's the only potential offset. Remember that unfortunately 75% of your FX comes from the mining sector. Okay, because we don't have the financial sector to bring in until we get this debt sorted out. We don't have the financial sector to step in. Once we get the debt sorted out, the bond market actually becomes one of your biggest suppliers of dollars. Okay, and it actually competes very strongly with the copper industry. So the problem is the bond market has not been bringing in dollars since we've been in default. But generally, the bond market does bring in dollars whenever things are good. So your bond market and your copper industry are your two biggest conduits of dollars. Okay. And if you can get those two running, so here's the only potential offset for the FX rate that may slow down the 3% movement, but you have to have this in your head is that with copper prices up and copper output up, if China is back as well, copper prices can now sit up around 9,000. So remember last month we had copper revenues up $784 million. And that was higher than the $600 million we were dealing with. They were up to almost a 10-month high. That is the positivity we might have. Okay, because when you got copper exports up that high, then you start to have mineral royalty taxes rising, while you also have mineral royalty taxes starting to rise, and you also have probably higher corporate profits for these copper companies, copper mining companies, that can then reflect in tax revenue for the government and in dollars. Remember that they remit their taxes directly to BOZ in dollars in terms of mineral royalties and that. So that money is sitting in the economy. So those dollars might be something that can start beefing up the economy. The problem obviously is the sentiment. But if you then couple that with the bond market, that's what you really need these debt negotiations to start going well, because then the bond market starts becoming a conduit for dollars as well to then stabilize things. If that can happen, while you then start blending domestically part of the ethanol. So you remember, you're not taking all the oil producing it. You're maybe taking about 20% of it, and you're producing 20% of it domestically, and then you're bringing out the FX risk and everything. Those are part of the things that we should start looking at. Those are three of the major factors. But worst case scenario, you have to prep yourself that nothing changes, and you're going to be experiencing a 3 to 5% increase in your pump price going forward. That's what you're looking at in terms of nothing changes. So that's the mindset. So oil stocks, yes, they're going to be celebrating. Oil companies right now are celebrating because every time they probably buy ahead of time, they probably bought a bit of stock. They've negotiated quite well, and they're going to be able to reflect that into a wider profit margins. Companies like Puma Energy, those ones. But the problem is now a lot of the food sector and the consumer might be under pressure because of rising energy costs, rising fuel costs, and transportation costs. Now, Vernon, one last thing in the market before we dwell on this point. I think that's my outlook I've given to people. One last thing in the market today is news has come out. The first read of of market data, or sorry, the first read of results has started to come out. We've been waiting for results to start coming out from listed companies, and unfortunately, we have not been getting them. The first one we've actually gotten out is a trading statement for Airtel, which actually has its year-end statistics. And here we are, Airtel's year-end statistics according to the Lusaka Securities and Exchange requirements. Here's the trading statements. They are going to experience a 33% increase in a 33% higher than expected profits. Okay, so they're expecting that their profits will come in 33% higher than the year before, higher than December 2021. So year-end profits are up 33%. What is that? Primarily driven by a 14% increase in customer base and a 24% increase in revenue, respectively. So they've seen that their customer base was up 14%, their revenue was up 24%. And if they've seen, it shows that their profits are up 33%, it either means that their financing costs are down, which may be the case, but either their financing costs have started to come down, while simultaneously we're also seeing probably their costs of management are probably starting to come down, or the operations costs are starting to come down. So that's a good news for one of our major stocks in the economy. That's one of our billion kwacha stocks, performing quite strongly with a 33% increase in profits, driven primarily by 14% year-on-year growth of customer base and 24% year-on-year growth of profits. Now, one of the main things I'm always looking at with Airtel is, where's the source of the growth coming from? Is it coming from the run-of-the-mill Is it coming from talk time, SMSs, or internet? Now, the fastest growing part of Airtel and also the telecom sector for a long time has been the internet service provision, because everyone has gotten used to having smartphones, transitioning their lives to smartphones. We're doing the show using internet. I'm not going to say which brand, but we're doing this show using internet. So you can see the demand for data is actually starting to pick up, because data is becoming more and more of a part of Zambians' lives. Also, if you take into consideration the usage of social media, Zambian social media users have moved from 300,000 at the beginning of 2010, so beginning of 2011, to now 3.5 million by the end So that's a tenfold growth in Zambian users of things like social media, and social media time is also growing. Even Zambian time spent on TikTok. TikTok is actually one of the fastest growing things in Zambia. So if you're looking at data usage, especially amongst the younger Zambians, about 70% of data usage and smartphone usage in Zambia is Zambians below the age, or Zambians who are considered youth, so 35 and below. They make up all the smartphone users, and they make up all the data usage, and they're using it for things such as social media, digital commerce. That's why I said when you see the rise of things like video content creation and also digital commerce, that's even why ZRA is paying attention to things like the gig economy. So this is a good sign. So my main thing when we're going to be looking at the financials is we're probably going to see the growth of data, but what we're going to see probably is also the growth of communications due to packages. You know, the war on package prices between the main MNOs, the mobile network operators, the war on that. Now, remember that Airtel does not include Airtel Money. None of our mobile money operators want to share their mobile money parts of the business into their stocks, though that should be part of the deal. Because I promise you, when it comes to Airtel, if we did have a slice of mobile money in there, we probably would be more confident in buying into that. That, Vernon, is the roundup of the markets today. Big news, obviously, China has recovered in terms of manufacturing. Oil prices are set upwards, and the trajectory is probably going to continue moving upwards due to the fact that the FX rate is going to continue eroding until we make a fix to the structure. And Airtel has actually released its financials. It started to release its trading statements for its financials, showing a 33% rise in profits, mainly driven by a 14% rise in customer base, which is actually quite a surprise to me. They had a declining customer base for a long time, a 14% year-on-year rise in customer base and a 24% rise in revenue. That's the roundup, Vernon. We will check you out tomorrow.
Thank you so much, Mtwale. Have a good one.
Cheers.